Self-invested personal pension. A SIPP is a self-invested personal pension. It is a UK pension arrangement that gives the individual far greater control over how their retirement funds are invested, rather than restricting them to a narrow range of standard pension funds. In simple terms, it is a do-it-yourself pension wrapper with significant tax advantages. Core concept. A SIPP is a tax-efficient pension wrapper that allows investment into a much wider range of assets. Rather than the provider selecting the investments, the investor or their advisor makes the decisions. Key tax advantages. Income tax relief on contributions. Contributions attract tax relief at the individual's marginal rate. Basic rate taxpayer. Pay £8,000 and HMRC adds £2,000, giving a total pension contribution of £10,000. Higher rate taxpayer. A £10,000 contribution may effectively cost £6,000 after full tax relief is claimed. Additional rate taxpayer. A £10,000 contribution may effectively cost £5,500. This remains one of the most valuable tax reliefs available in the UK. Corporation tax relief for company contributions, where a limited company pays into a director's SIPP. The contribution is normally an allowable business expense. It can reduce the company's corporation tax bill. There is no employer's national insurance. There is no employee income tax charge. There is no dividend tax. This makes pension contributions one of the most tax-efficient ways to extract profits from a company. Tax-free investment growth. Within a SIPP, no income tax is charged on dividends. No capital gains tax is charged on investment growth. No tax is charged on interest received. This means investments can grow in a highly tax-efficient environment. Tax-efficient retirement withdrawals from age 55 rising to age 57 from 2028. Up to 25% of the pension fund can usually be taken tax-free. The remaining 75% is taxed as income when withdrawn. With careful planning, withdrawals can be structured to reduce the overall tax burden. What a SIPP can invest in. This is one of the main distinctions between a SIPP and a standard pension. Typical investment options include shares and ETFs, investment funds, commercial property, corporate bonds, government bonds, cash deposits. This flexibility is one of the main reasons why SIPPs are popular with business owners. Commercial property within a SIPP. A SIPP can be used to purchase commercial property. A common example is where business premises are acquired through the director's SIPP. Potential advantages include the company pays rent to the SIPPee. The rent is tax deductible for the company. Rental income builds up tax-free within the pension. Capital growth on the property is free from capital gains tax within the SIPP. The property may fall outside the individual's estate for inheritance tax purposes. This can be a very effective long-term planning strategy. Annual contribution limits. The standard annual allowance is £60,000 per tax year. Unused allowances from the previous 3 tax years may also be available under the carry-forward rules. Higher earners may be affected by the tapered annual allowance, although planning opportunities often still remain. Why business owners favour SIPPs? For directors, pension contributions are often significantly more tax-efficient than taking dividends. For example, £10,000 extracted as a dividend may leave around £7,500 net. £10,000 paid into a SIPP results in the full £10,000 being invested. Over the long term, that difference can be substantial.